Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
On today's show, I'm talking to Martin Estlander, the founder and CEO of Estlander Partners. As the oldest CTA firm in Scandinavia, Martin has seen a lot of changes in the past 2 decades, but has continued to innovate and expand his product offering to investors, and staying true to his origins and his values has also won him international praise for his efforts. For those of you who are new to the show, I just want to let you know that you can find all of the show notes, including a full transcript of today's episode, on the toptradersunplugged.com website. Now let's get started with part 1 of my conversation. I hope you will enjoy it. Martin, thank you so much for being with us today. I really appreciate your time. There are a couple of things that stood out to me as I was preparing for our conversation today. I noticed that you started Estlander Partners in the same year that I began to work in the CTA industry, namely in 1991. So apart from disclosing that we both have a few gray hairs by now, it also makes your firm one of the oldest Scandinavian, if not the oldest Scandinavian CTA, and certainly also one of the longest running CTA firms in the world. But of course, the other really interesting thing about what you have demonstrated during more than 20 years of successfully building and managing your firm is the fact that you've done it away from the busy streets of Mayfair or Midtown Manhattan, in your case in Vasa in Finland, where we know that the pulse is a little bit different from the usual financial hubs.
Yeah, that's right.
So perhaps a good starting point for today's conversation would be for you to take us all the way back to the beginning. Tell us your story of how you got involved in the business in the first place, and take us through the evolution of Estlander Partners to where you are today.
All right. Well, I'll do my best. As you noted, it's a long story, so there's many years to cover, but I'll try to make it short, though.
Fantastic.
And, well, it's my good friend Carl Renlund and myself, we started trading back in the 80s, in like 86, started trading equities, and then we were just about to graduate from university, and we figured it was very inspiring and gave a lot of energy, and we found it really, really interesting and decided to go one step further. So we set up a firm to trade options as market makers in Stockholm.
Okay.
And we did so, and it was a bit tough in the beginning because we didn't know anything about the options, but we learned some of it, and then we had the crash of '87, which obviously was a fantastic trading environment. Sure. And that led then to a couple of institutions, the Finnish and the Swedish, coming in and buying up the firm. And together with them, as partners with them, we then expanded the options market making business to Finland, and then to Norway, to Germany, and Switzerland. So that was a lot of fun, and it was great to be in the evolution of the derivatives market in Europe at the time. Myself, I had a degree in computer sciences and economics from the university, and I felt somehow that I wanted to try to use my programming skills. So I started developing decision support systems, and that's how I got into sort of CTAs and started looking at some of the traders and type of systems that they were building and started experimenting myself. And that led then to the start of the trading in 1991. And at the time we were working in Frankfurt, so it was a sort of a German enterprise for the first few years.
Mm-hmm.
And we ran the two businesses in parallel for a number of years, and eventually we then decided to focus more on the CTA business, and we actually exited the options business in 2002. But they were sort of two integral parts throughout the history, and the whole options trading and market making sort of history has dominated our DNA as traders in to quite an extent. So we tend to see everything in terms of optionality and volatility, and I think we measure also trends and opportunities in the market slightly differently than many other CTAs.
Interesting.
But a little bit more about the history. I think when we started in 91, we got our first institutional clients in 92, and in 93 signed up with the Commodities Corporation, and basically we were part of the team at Commodities Corp until 1998, when Goldman Sachs came in and bought the firm.
Sure.
That was a very exciting and inspiring time as well. I got to know a lot of interesting people and a lot of interesting traders and a lot of inspiration, and had a lot of fun, and it was great being a little bit in the States as well, and seeing the US part of the business. But at the time, it was very unusual to be a European CTA, and I think sort of people felt it was diversification to invest with a European CTA, although we basically traded the same way as the American ones.
Yes.
But it's still obviously the US was very dominant in the business at the time, which, as we know, have then shifted a little bit back to Europe, or more and more to Europe, actually.
Sure.
But going back to the evolution, Jan Haraldsson, a good friend of mine from sitting at the same desk trading options in the 80s, he traded the Alpha Trend program that we run today as well, more as a proprietary trading approach, and we didn't have any clients for quite a number of years, and then sort of joined Estlander Partners, and we set up the first fund for external investments in 2008, and so Jan came sort of on board fully quite late, actually, but he's an important piece of the firm.
Sure. And it must have been, I mean, it's interesting that you mentioned the Commodities Corp side of things, because of course people who know about the CTA industry also know that a lot of the really great traders, who some of them are still around, certainly also had a stint of their early career with Commodities Corp. So that's obviously a fascinating part, because it's not something you would normally associate with a European, let alone maybe a Finnish company, that your roots actually go back to that time as well.
Yeah, no, that's right. There are a lot of, I guess, Paul Tudor Jones, Louis Bacon, and a lot of other guys that are still around.
Absolutely. Well-known names for sure. Yeah. So, and the whole trading side, you mentioned that you started trading equities and so on and so forth. And was this something you knew all along when you were studying and maybe finishing your sort of, late high schools or early university, that the trading, the financial world was where you wanted to take your own career?
No, not really. Actually, it's just like living in the moment, I guess, and found it very, very exciting. And I guess it was like many things in life, a coincidence. Mm. It was a bull market, and it was. So I guess we felt that, wow, we were actually quite good at this, because we made some money and we could finance our studies. And it was only later that we realized that the reason we made money was it was a roaring bull market.
like so many at the time, but yeah, no, excellent. And obviously we're going to talk a lot about the business, the programs, but I wanted to ask you sort of first off in a little bit different direction. You know, no doubt that trading, running Estlander Partners takes a lot of your time, but what do you do to relax? What do you do when you need to take a time away from the business and the trading?
Oh, it was a bit of a surprising question. I could easily talk an hour about that. No, I guess it's you know, it's good to mix different things and be able to relax, and obviously the family is very important, and
Sure.
spend some time with that. But I like to do a lot of sports, so that takes up quite a bit of time. Now the sailing season has just started, so we're racing a bit now and preparing for 2 world championships later on in this summer.
Okay.
So I'm skipper of a team which is actually representing Finland as the national team of Finland in these two championships. So for during May, early June, sailing is a big piece of my spare time.
Sure.
And then a bit in August. But then during the winter, it's more like skiing and playing tennis, I guess. And then for relaxation, I also I meditate daily, and I find a lot of inspiration and a lot of energy from really relaxing and quieting down the mind. And it's an extremely interesting sort of field of I guess not science, but at least it interests me a lot, and there's many parallels between trading and the way the mind works. And I think the way we are designed as human beings, with our emotions and our reactions, our instincts, etc., is what actually drives the market in a way which makes it possible for systematic strategies to make money.
Sure.
And that also affects how we live in our daily lives. And the same way that you can impose discipline upon your trading, you can also impose a certain amount of discipline as to how you deal with your own stress and emotions, and how you view things, and how you try to avoid to overreact to certain short-term events, and cope with drawdowns and stressful business running, etc. So that's me a little bit. I spend a lot of time thinking about these matters, the philosophy behind what's driving the markets and what's driving our human mind.
Fascinating, Martin. And I actually have heard that from a number of people that really combine, their stressful working life with something very different, and looking much more inside themselves to get away, so to speak, from the more business oriented part of their life. But very good, Martin. Perhaps you could give me a little bit of an overview of the programs you run today, and you mentioned one of them officially to the outside world opening in 2008, but maybe just give us a brief overview of what the business looked like today.
Yeah, sure. Well, we have 3 main programs, of which Alpha Trend is our sort of largest asset-wise. Alpha Trend is a very pure trend-based strategy. So it's really a trend-following strategy that's been running along the same lines of philosophy since the start in 1991.
Okay.
And obviously developing over the years, been refined and sort of improved, but the profile is really to be a pure trend-following strategy, and not mixing in a lot of other things into that. And whereas our Freedom Fund, which is more of a multi-strategy fund, includes Alpha Trend, but that also includes other things such as short-term trading, systematic macro, carry trading, and that makes it sort of a more broad strategy. Also, global markets is a variation of these with a 50-50 division between systematic macro and quantitative trend trading, whereas Freedom is more like 75% quantitative trend-based trading and 25 systematic macro.
Okay.
And then we launched a fund called Presto fairly recently, which is sort of short-term, up to 3 days holding period, and trading also a global approach, most of all the 4 asset classes. And so these are basically the offerings that we have today. And it seems like some investors prefer the more diverse sort of multi-strategy approach. We do have products along that strategy line more offered here in Northern Europe through distribution channels, through banks, to some pension funds, whereas the Alpha Trend, the pure trend one, seems to be more appealing to investors that have other managers as well, and sort of are more seasoned CTA investors, in the sense that they have many CTAs, and they sort of find that Alpha Trend is quite different from some of the other CTAs, and hence provide good diversification in the CTA portfolio.
Sure. Excellent. The next area I wanted just to touch upon briefly is sort of just how you decided and how you've done over the years in terms of organizing your business. Nowadays, clearly, technology has provided a number of options that you didn't have when you first started out. But if you look at the various sort of key areas within your business, how have you organized that? What have you kept in-house, so to speak, and what do you outsource today in running your business, if anything?
Well, we do outsource auditing the accounts. And in terms of software, I guess the Bloomberg terminal is sort of external software. But other than that, everything is more or less an integral sort of platform that we've designed over the years. I think it's a 3rd generation of fully integral platform that we run today. So everything from data collection, data cleaning, storing, and running the models through sort of communicating with the markets, with the brokers, reconciling the trades, several times a day automatically, and then calculating NAVs for the funds.
Sure.
We do that in parallel to the administrators.
Sure.
Report to clients, and reconcile everything that is done. But basically, it's the idea is that it's all a very integral process, and we need to keep very good track of all of the operational risks, all the aspects of the business, in terms of where we get the data, what type of data, where we have backups for the data, how we clean the data, how we have business contingency plans, and how we have a couple of offices so that we can run the business from the other location should it be needed. And, I think technology is extremely helpful and makes it much more efficient. But it's also, not just opportunities, it's also challenges, of course, with the further with the increased speed of the markets. It's put new demands on execution, but also provided obviously opportunities. And so I think the way the business is executed in the market is something that has developed and changed quite a bit over the last few years. But it's it's all for the good, and it's I guess in the long run that's to the benefit of all market participants. It's getting cheaper to execute.
Sure.
faster.
Yeah. Before we go in and talk about sort of the program itself and talk about models and how you go about that, I wanted to start out by having kind of a bird's eye view, looking at the track record. And what I mean by that is track records nowadays probably have to be read with a little bit of background information, meaning that firms that have been around for 2-3 decades, their trading has probably, or their model has probably evolved over time. So what you see when you look at a track record may not exactly reflect how the program is configured today. So when you look at your own programs and you look at their track record, would you say that they should be read in stages, meaning periods where you've had some significant upgrades, research discoveries, or has it been more of a smooth evolution that hasn't really taken the programs away from its origin?
Yeah, well, I would certainly say that it's more of a smooth process, and it's been sort of a stepwise refinement. But I think reading the track record, the most important thing you would see from the track is the result of a process of research and running the business in a certain way, and points to a certain sort of expectation regarding future stability of the firm and the research process. So I think that is what I would say is the most important part to read out of any track record, really. And when it comes to how the program has changed, I think, well, certainly it's been improved, and we've improved how trades are filtered out, how to avoid unnecessary trading, taking on new markets, new ways of executing the trades, and new ways of selecting trades, and so on, entering, exiting. But the general theme of what we're trying to extract from the market, that's really been very much the same over the years. So I would sort of really focus on that, and if not, or reading the track record, the stability is one, and then the second would be to sort of compare the track to the different economic cycles and the different sort of market environments, and see how it's been performing in different environments, and sort of draw conclusions for the future based on that. I guess that's how I would read the track.
Sure, makes sense. And speaking about different environments, I don't think it's a big secret that the environment for CTA since 2009 has been different, in many cases difficult. How do you view the environment, and how do you view the Alpha Trend's performance in the context of the different environment that it's been in? Has it performed as you would have expected, also during the difficult time?
Well, it certainly has not performed as I expected in 2009. But when we look at the environment and the actual drivers of the returns throughout the different cycles, one of the big conclusions that we've drawn is the fact that the volatility environment is so important in describing the returns and the return opportunities. And in fact, a trend following strategy is a very sort of long gamma strategy. It's long volatility. And in particular, if we look at volatility on a slightly longer horizon, say a 3-month horizon, and we look at the development of the volatility as an index across all the asset classes and all the instruments that we trade, what we can see is that there's a very high correlation between how that volatility, the 3-month global volatility, changes and the performance of the program. So we're actually very, very long this volatility and exposed to the change in volatility. And looking at the environment going back like 50 years or so, one can see that this obviously varies. Volatility is a mean reverting figure, and which has its peaks and it has its downs. And it had a large peak in 74 during the energy crisis, and it had a huge peak in 2008 after post-Lehman, the financial crisis.
Sure.
And what we've seen now since 2008 is the steepest fall in this volatility level that we've seen in sort of 50 years. And if we're highly correlated with the change in this volatility, sort of we're long the change in this volatility, and it's more or less been falling like, as I mentioned, I've seen the biggest fall in 50 years. It sort of describes why it's been so difficult. And I think from that perspective, it's not all that surprising, but I can't claim that I had this insight in 2009 and maybe we would have done something differently. I don't know. But the truth of the matter is that now we've come down to levels which we haven't seen in the world since Bretton Woods in terms of low volatility. And it's a fantastic opportunity from that perspective. I mean, CTAs want this volatility here to be flat. That's fine for making money, and preferably increasing. And once this volatility is now so extremely low, for obvious reasons. I mean, that's the policy that governments and central banks have imposed since 2009 have been extremely successful in pushing down this volatility. But it's hard to see that it could go much further down. It could stabilize here maybe and maybe go up. I don't know.
When you talk about volatility in that sense, are you looking across all sectors, including commodities, or are you focusing more on the financial sectors of a CTA portfolio?
No, in particular, looking across all the assets, all the asset classes, and all the individual instruments for that matter. So it really is, the measure is really designed to really reflect the CTA portfolio.
Mm. So. Now we're going to talk about the Alpha Trend program, and just staying with this theme a little bit longer in terms of the sectors and in terms of the putting the performance into some kind of context, in particular in the last few years. It would seem to me, at least, that the people who have done well, because certainly some people have done well in the last few years,
yes,
have been overweight certain sectors, maybe in particular bonds and equities, and despite, as you say, volatility coming down, that doesn't mean that these strategies can't make money, because clearly if you were long term and you were long equities, you would have made, you would have done very well. So how does that is that to imply that when we look at the Alpha Trend program, that is more of a fully diversified program and not overweighting any one particular area?
Yeah, well, we're certainly sort of aiming when designing the portfolio to find the broadest possible diversification. And looking at the different asset classes, we know that equities obviously have an intercorrelation which is fairly high. Mm. So all the four main asset classes, equities would be the least diversified.
Sure.
Also, the bond markets have a certain intercorrelation, as do FX, and the most diverse one is the commodity segment with energies, softs, meats, metals, precious metals, and the different energies. So it's certainly offers the best diversification, and hence it's also shown up in our portfolio as the biggest of the four sectors.
Sure.
Now, needless to say, equities obviously have been, the commodities have been the most difficult over the last few years.
Sure.
And looking at the volatility development, the one that I referred to before,
yeah,
the steepest fall has actually been in commodities, and it's the most extreme development in that segment over these few years. But in the long run, we strongly believe in that, and it provides great diversification. And we are not so much into timing and not trying to time the portfolio back and forth. We're just trying to keep an as robust, smooth and balanced exposure to all sectors as we can. We think, our research clearly shows that over time it will pay off, but certainly this has been a challenging period now.
Yeah. Well, tell me a little bit about, in your own words, about the structure of the program and why you've designed it in this way. Talk a little bit about, the number of markets you trade and the number of models that is involved in the Alpha Trend program.
Well, we trade 74 different single instruments, and then we also trade combinations of instruments, which provides good diversification. Something we have introduced to the portfolio since the financial crisis because of the increase in correlation across markets. Fortunately, this is now coming down, which is also together with the very low volatility level now. The falling correlation obviously is a very positive sign looking forward. So all in all, we trade about 100 different underlyings, including these combinations. And the approach is very selective. So not in the market all the time. We're in the market maybe 3 to 4 times a year per instrument, and with a average holding period which is clearly shorter than CTAs in general, on average 30 days.
Okay. So
we're in the market less than 50% of the time. So a very selective approach, and going in with higher conviction when we go in, and using a combination of statistical methods and pattern recognition methodologies to identify the opportunities when we trade and when we don't.
And can you just to describe to the listeners who may not be sort of fully as versed with these things as maybe you and I are, but I mean, can you try and visualize what you mean by pattern recognition and how this might be different from maybe the traditional moving average crossover or price breakout?
Yeah. Well, pattern recognition can mean a lot of things, but it can. But we certainly apply it in the quite long term, so that we identify what type of market structure is present. So, is it a market that is currently in a larger trend upwards, or maybe it's a larger trend downwards or sideways or whatever, and maybe it's a market that's already reached a very extended state, or maybe it's in a very consolidating state. And depending on what sort of state the market is and what sort of structure the big picture have, we then apply more short-term patterns to identify how the more short-term sort of price action goes together with the bigger picture. I mean, they both match. Both the big picture, for instance, speaks for good opportunities on the long side for a trade, and the shorter pattern also suggests that investors are lining up for more support for a long trade. And if you then see the price take off from that pattern, then we would enter. And the idea is just to try to identify how investors view the market and how they are likely to react to future price changes. So it's all about trying to assess the opportunities and sort of probabilities for a trade going forward.
Sure. And are you looking for some kind of momentum breakout in the direction that your overall filter is suggesting the trend is? Is that what you're looking for in the shorter term?
Well, actually, we're trying to to identify the opportunities without relying on the momentum. Because we do also use momentum. If we can't find a pattern and there's a very strong momentum, we will also use that. But in the ideal situation, we can enter before the momentum confirms the trade.
Okay.
So we try to get into trades a lot earlier than most participants do. So in the ideal situation, we really enter like a very short-term trader. We go in with a very short-term pattern and try to get in very early into trades.
And is this a sort of an end-of-day kind of approach, meaning that you only need to run the model once a day in order to identify these opportunities, or does it actually look for even price action intraday?
Well, both actually. For the big picture, the big picture is sort of analyzed on a daily basis, so it's run sort of once a day after the market closes.
Sure.
And then intraday, we sort of read the action for more short-term sort of information, and we actually react or try to react in intraday when the opportunities arise and filter the trades on a minute-by-minute basis.
Okay. And if you do get a signal to take on a new position, does that then get scaled in, or do you actually say, no, we have a signal, let's take our full risk on at this point in time?
Well, again, execution is extremely important. So you have to, or what we try to do is sort of read the market action on a minute-by-minute or hour-by-hour basis, and then we try to get in based on what the opportunity set is in the short term. But I guess sort of your question is perhaps more geared towards the sort of daily phasing in and phasing out. And I would certainly say that when the opportunity is there, we try to get in fairly quickly, maybe over a day or over a couple of days. So, and then hang on to the position. So more sort of binary, sort of high conviction based, going in, building up the position quickly, rather than sort of gradually phasing into a position.
And how many, I don't know whether this is the right definition, but how many models would you say you run in each market, if that's the right way to describe it?
Well, we really consider it sort of being one model. I mean, we run the same model across all instruments in all environments. And then we try to integrate all the different considerations into this one approach.
So it's building up conviction for each market and giving it some kind of score to say, we should now be 50% long or we should be 75% long. Is that how it works? Or is it we're either long or we're neutral or we're short?
Well, we do scale it. So
okay.
Obviously also scale it with the volatility. So the market volatility plays in. If volatility is lower, we take on bigger positions. If volatility is higher, the positions are smaller. But we also scale it with the risk management and the overall risk in the portfolio. And I think that's sort of an important piece of the model as well. And basically aiming at trying to get into when the world starts sort of moving and market starts moving, then we try to get into the action as quickly as possible, and with the earlier positions and those that were taken on earlier, they are getting typically more priority and more risk, and are in that sense bigger than those that come on very late when the book is already maybe quite exposed and we have a fair amount of risk in the book. So the positions get then down prioritized and get smaller exposure.
So the risk budget is not really individually by market opportunity. The risk budget takes into account what you may have already on in other markets in the same sector or in other markets, generally speaking.
Yeah, it certainly looks at the book as a whole, and yes, balance is based on how much risk is on.
Okay.
And we all view it from the risk perspective, and when looking at things from a risk perspective, we don't believe in too much in diversification, unfortunately. And when the really difficult situation occurs, then correlations can quickly go to one. Yeah. So there's very little diversification benefits to be assumed, and hence there's little point, we believe, in sort of splitting up a risk per sectors. It's, in the worst case scenario, everything is just one big position with highly correlated components. So that's the risk we need to focus on.
And do you then, when you enter a new market, does the model allow you a stop loss every day, so to speak, or is it actually a change in the signal or the conviction of the signal that tends to reduce the position size and may even take the position out as a whole?
Well, it's certainly both, I would say. There's sort of a continuous analysis and a dynamical change of where we expect to get out of positions. But whenever we take on something, we always have a stop in. So there's always a stop loss in each of the markets where we have risk on. And that stop then also changes continuously as the market moves. And when it changes, if the market move is fast in the direction of the position, then both the exit level and the stop level will sort of change with the move more quickly. And if the move is slower, then they will move slower.
Sure. And do you use any kinds of stop profit, so to speak, or is it like in the classical sense of trend following that actually you need to let the positions run for as long as possible, and only if you get a big move against the trend you're in, you start lightening up or getting out entirely?
Well, that's certainly the dominating way of getting out of positions.
Sure.
However, if there is a very strong move in the direction of the trade, then there is a mechanism for taking some profits at those extremes as well.
Sure. So that will certainly be one.
Seldom occurring.
Yeah. What would you say, looking at the model, what do you feel is sort of the key performance drivers of the program as a whole, in terms of, its difference or its uniqueness? You mentioned that compared to maybe some of the other classical trend following programs out there. Is there anything that you think of as being in particular important, creating this difference when you look at how you've designed the program? Whether it be the way you size your positions, whether it be your time horizon or your entry.
Yeah, well, certainly the program was not designed to be different. It was really designed just to reflect the trading style that we represent, and then that turned out to be a little bit different. Maybe it's different for you mentioned us being up in Finland away from London or New York, and maybe we think a bit differently being off the main bus in the street. I don't know, but we do it just the way we're comfortable with, and that turns out to be a little bit different. And I guess the points that I would highlight is the way we balance risk, as we discussed before.
Sure.
So looking at the overall risk and sort of if prioritizing certain early positions, then the mechanism of trying to get into positions early. So that certainly brings some of the differences, and looking at the track record when the market have seen sort of inflection points, that's typically where the difference has been the biggest. when it goes from, so if you look at in 2009, when early spring 2009, when the market had come down, like all risk assets had come down very dramatically, and then when it changed around, it took us only like 2 weeks to be, or less than that, maybe 1 week to be on the long side, and we sort of catch the move up much quicker than most sort of slower traders. And so in those inflection points, it plays out to be sort of more reactive and faster to get in.
Sure. And the general theme that you mentioned, getting in early, getting in before maybe the momentum, the volatility starts to expand, does that allow you actually in some ways to put on a bigger position than maybe other managers at that stage, because you're doing it at a time where volatility is low in that market?
Well, that could very well be the case. I think also just the fact that we're out of the market most of the time, and we only trade in high conviction situations, that alone will lead pure mathematically to larger positions when we do get in, just to reach the same volatility level. So yeah, we certainly get in with more size relative to others when we go in.
Sure. In terms of the actual trade implementation, how does that work? Just from a purely practical point of view, you get your signal during the day. Does that then automatically feeds into some kind of execution model or part of the program, or how do you actually do your implementation?
Yeah, well, when the model says that, okay, now we need to get long gold, that information will then be passed on to the execution algorithm, which is sort of a separate algorithm, separate system, which will then have one trading session to get into the position, and will then sort of analyze the short-term action to optimize for the best possible price to get in. So that leaves its own little life during that particular trading session to try to optimize for getting in. And again, it's a separate module. It's a separate sort of straight through processing trading module that tries to optimize the price and tries to be fast and watches all the stops and all the levels and all the information that may trigger us to either be faster or more reactive or hold back a little bit.
So in fact, there's no real human intervention even in the execution side. Everything has been pretty much automated. Yeah.
No, that's right. There's always somebody overseeing everything.
Of course.
Approving the trades before they go into the execution model and then overseeing it, but is not calling any shots during the day, really.
Now, another topic I wanted to touch upon is risk management. And I wanted to start by asking you a little bit about how you define risk. What does risk really mean to you? And then how you go about dealing with it and managing the risk in terms of whatever target you have.
Yeah, sure. Well, I think the risk management approach that we run is sort of divided into.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.